You are listening to Keystone's Stock Talk Show, episode 209. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to be back with you this week. We have a busy show, starting with a brief discussion of our research trip to the Planet Microcap Conference in Las Vegas. We will then shift gears to Aaron with another earnings season review segment, including a look at the numbers from Microsoft, Alphabet, Amazon, and Meta, which all reported earnings over the past week. Brett will take a look at one of the biggest stories over this past week, the collapse of First Republic Bank. Finally, if he was recovered enough from Las Vegas, Brennan will look at the recent strategy of mortgage extending that Canadian banks have been beginning en masse in an attempt to help ease the pain of some Canadians that are facing in this higher rate environment. So let's get to the show. I'm going to welcome my co-host, Aaron, and the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Yeah.
Welcome back.
Good. Big week for you guys.
Last week, it was. We were in Las Vegas at the Planet Microcap event. There's about 80 small and microcap companies there. A couple of companies that we're very familiar with that we sat down, had dinner with, JEWL and Envela Corporation. Know the management there. Got to know them even further. Have sat down before with the management of JEWL, but haven't sat down in person with Envela. So it was good to sit down with them, pick their brains, find out about them, because they are, after all, the intellectual capital behind the investments that we're putting our money in and our clients' money in. So it was interesting to sit down, and we interviewed, about 14, 15 other companies, Brennan?
Yep, on the Thursday. And the interviews went pretty well. Basically going through our recent US sweep, we've already pulled out a lot of these names that were already at this conference. So it was kind of nice that we jumped on a call with them about a few weeks ago, got to actually sit across from them as well and shake their hands. So that was great. That was a long day. We didn't have a break on that Thursday until right before our last meeting. And at that point, it was like, can we just get the last meeting over and done with here? But no, good conversations. And it was good.
When we flew in the first day, I did a panel hosted by the event organizer, and there was 4 analysts, a fund manager from Montreal, one I believe from California, and another analyst was on the panel as well. So it was quite interesting. Went through kind of our strategies, what we're looking at in the markets right now, where we see value, things that keep us up at night, all those standard questions that you get. And I got to say, I just dominated the panel. So It was great.
Sure. Yeah, that's what
I only showed up halfway through. So
Brennan was still just recovering from his flight and, had to go in the room and
so
powder
what's
his
keeping everybody
face
up at night,
whatever he does.
Aside
for me,
from
I
your
talked
dog
about...
that's barking through the night.
Yeah, I said it was literally my dog's
sorry.
vicious diarrhea and my kids are keeping me up at night. That's the only thing. But I talked about the fact that interest rates have gone higher and consumer spending has just kind of stayed the same. And whether those two things come head on into each other at some point, that probably keeps me up at night more than anything. Although, again, it is really just the dog that's keeping me up right now. Mm-hmm. But those are issues that we talked about. There was a number of other, things that people went into. But let's be honest, nothing that deep. Just kidding. No, the other analysts they're quite good. It was a fun panel, so it was good. It was good. And we talked about. I like to give examples of companies that we've liked in the past. We talked about one of the questions was something that you've learned like over the past 10 years or maybe 20 years that you may not have known at the start, something that you've altered in your research approach. And I just talked about one of the things that, that I've learned over time is like, you don't always have to find the cheapest stock and the most, the stock with all the dirt on it that you're polishing off and trying to find an underfollowed gem. Sometimes it's okay to pay a reasonable price for a great company or a really good company. And those are one of the things that, you learn over time. And I used, for example, Aritzia as an example of that. Like, it wasn't the absolute cheapest stock that when we bought it, back when it was $16. And then we've just had a new rating out. I'm not going to say what the rating is right now because we just released that to clients over the past couple of weeks, but it's not the cheapest stock again at $43 now, but does it have a great runway of growth ahead of it? Yes. Is it trading at relatively reasonable valuations given its growth and given the high quality of the business? And will I look back on it 5 years from now, 10 years from now, and be thankful that I bought? Those are the questions that you kind of ask yourself now with 10, 20 years experience in the industry that you probably didn't 10 to 20 years ago. And, it was good to go through that. And I went through, Aaron, when you presented on Warren Buffett's analysis that went into buying Nike, which is one of his, best buys of all time in the portfolio. It's not like it was trading at 8 times earnings and growing at 25%. It's probably growing 15 to 18% and trading at between 18 and 25 times earnings. So high quality company, not the cheapest stock out there, but at a reasonable price. So kind of use those examples too as well. So hopefully we came across well at the event. I think it went well. And then I did a couple fireside chats, talked to the management from Envela in front of the crowd and the management from JEWL in front of the crowd as well. There was some amazing technical difficulties at that time, which is really fun to go through. But I think the message from those companies got across, and really they're just, it's them that are really presenting. I'm there just asking a few questions.
Yep.
All right. So any companies that stood out to you, Brennan, that we were there? I mean, probably just the companies we already have.
Yeah, I don't really want to say any names really too, because we're going to
be, there's some companies we're looking at closely that were there.
Yeah. He's putting me on the spot, and I actually don't have any names in my mind, so I'm just saying that.
He just went blank.
Kidding. No.
Well, one company, I did a quick, kind of like we would a Your Stock, Our Take segment, because there's one company on there. It doesn't fit our full criteria yet, but Brennan will have some comments on it because they are in the diamond industry, loosely speaking. Not loosely, they're in the diamond industry, and it's Brennan's little pet favorite, that industry. So why don't I just look at this company? We interviewed management there, and we'll go through it like some viewer asked a question. So the company's called Adamas, Corp. Symbol is JEWL, or JEWL on the NASDAQ. It's about 77 cents, $16.3 million market cap. So a true micro-cap company. They are a lab-grown diamond manufacturer and producer of nearly flawless single crystal diamonds for gemstones and other industrial applications in their facility in Grenville, South Carolina. The company holds 36 patents and uses its proprietary chemical vapor deposition, or CVD, to grow gem-sized and smaller diamond crystals. The company's diamonds have the same physical, chemical, and optical properties as mined diamonds. So let's look at the balance sheet from the last period. This company just listed in December and has had share price go down precipitously over that time. But I'm going to look at the balance sheet, then we'll get to where the share prices come. As at December 31st, the cash was $3.46 million in the bank. Total current assets are $5.32. Total liability, $7.13. So there's a working capital deficit right now of just under $2 million. It's not something we like to see, but not completely alarming right now. So the stock price, like I said, is down 83% since it started trading in early December on the NASDAQ just around 5 months ago at $4.74. It's currently at 77 cents. Why? Well, I would say generally the environment for speculative small caps remains poor, but the valuations in December were high given the lack of significant revenues and what we would just call proofs of concept through sales. Ultimately, the company can forecast numbers all it wants until the market sees proof, It's just a forecast, and there's nothing really to fall back on. Let's look at the latest quarterly numbers. Again, the company is just getting started, but it's in its first quarter as a public company, sales were around $726,000. Adamas produced a loss of $6.73 million. Now, a huge percentage of the loss was from about $3.6 million in stock compensation and $2 million in warrants issued for conversion. Cash used in operations for the quarter after adjusting those was roughly $1.7 million. What is the plan here? It's to focus on its current facility, which houses 12 diamond growing machines, and get them to full capacity, at which point management believes the company will be capable of generating an average of 3,000 rough cut diamonds per month. Recently, the company announced that with its reactors at full production capacity and full marketing underway, the company anticipates more than $12 million in annual sales from its current facility, like I said, in Grenville. Additionally, management intends to make a significant investment in building out the new facility, including building as many as 400 diamond growing machines. That would be a first phase, apparently. The first phase of that, would be apparently consist of installing 100 reactors, which at full capacity would be able to generate up to $30 million in top line revenue, or they believe $14 million in EBITDA on a monthly basis, or more than $300 million top line revenues with $150 million in EBITDA on an annual basis. Those are some lofty margins. Now, our take here, while the global lab-grown diamond market is estimated to have reached $26 billion in value as at 2020, it is estimated to now continue to grow at 10% from 2021 to 2030. The competition here, however, is high and growing. There are a number of companies with far more financial resources than Adamas One at present, already producing high-quality lab-grown diamonds, including a company called Element 6, which is a privately held subsidiary of De Beers Group. There's AOTC Group of the Netherlands, Pure Grown Diamonds. They're in US, Singapore, and Malaysia. WD Grown Diamonds, and a number of others, including Helzberg Diamonds under the brand Lightheart, which is backed by Warren Buffett. Now, the plans for Adamas One are ambitious. The company cites quality, its patent process, and insatiable demand for lab-grown diamonds as value creative for the business. The company also plans to enlist the services of prominent social influencers to further its brand, which could prove a smart strategy if well managed, but that will all take capital. Again, Adamas is lacking some at present, but the company is only in its initial stages, and it remains for us highly speculative. We monitor it, but it doesn't fit our criteria in terms of cash flow at present. That is speculative rather than investment quality at this stage.
That's interesting.
So
some grandiose plans.
For sure. And these are the companies we interview.
As of present.
Yeah. We interview and try to find out more about the businesses. This would be a very initial stage interview. So we got some information there, got some information ahead of time. Let's see if they can start to execute on that, create cash flow, and then we'll do the valuations at that point when they have some cash flow. But it is initial stages, big plans, but big competitors as well. So we have to monitor that.
Yeah, and that's like the biggest thing that I would say is like the barriers to entry to get into creating lab-created diamonds isn't that high. Like, I mean, we asked them how much does a reactor cost, and they were saying about $325,000 per reactor. So, I mean, realistically, like I brought up that number to my mom, and she was like, "Wow, that's a lot of money." That's not a lot of money, Mom, for someone that wants to get into, making diamonds. Essentially, it takes them about 30 days, and they can make about 50 diamonds in one of these reactors. But that's the thing. So, low barriers to entry. We're seeing a crazy compound annual growth rate. And people need to understand too that this isn't just from cannibalization of the natural diamond or natural mined diamond market. This is actually because these cheaper lab created diamonds are basically making essentially a new market because new people are able to afford diamonds essentially, and they're being brought into. So this growth is twofold. We're seeing both cannibalization a little bit, as well as, a new market for more fashion jewelry. So my thought going forward, and I have no idea if even natural diamonds will be able to support their own price going forward, but seeing, people chasing the compound annual growth rate in the industry, the low barriers of entry, realistically, it's not proprietary technology as far as I understand. The company that we talked to, the CEO, he said that the technology is proprietary. I would argue that it's not. There are many companies out there doing
anything
it.
can be proprietary.
Their process might be.
You could just put something unique into it and it's proprietary. That doesn't necessarily mean that there's any value to that proprietary technology or that it gives you a competitive advantage, right? So everybody likes to use the term proprietary. It may very well be, but that might not mean anything.
Exactly. And, I did show Ryan this chart. So this is from Paul Zimnisky. He's one of the leading diamond analysts out of New York. And you can see here that generally the price of natural diamonds has held its ground, but we've seen lab created diamonds come down quite rapidly. Whereas people don't understand this too. De Beers has came out with a predatory pricing strategy where they're selling these lab created diamonds for about $800 per carat for 1 carat diamond US, whereas a lot of these other competitors are around, $3,500 per carat US. So, De Beers is trying to preserve that natural diamond price. Who knows if they'll be successful in it. But with the further supply that we're going to see as people are trying to chase these potential returns, I just don't see a world where as competition comes, we continue to see these generic lab diamond prices come down and down. Who's to say? As Ryan said, I do like the diamond industry. Can't say I like it for much of an investment. It's more of just my little pet project that I like following because it's an interesting industry. But yes.
And you also like to wear a lot of jewelry.
It's true.
And yes, I am blinged out at all times. Correct.
You have a diamond in one of your teeth, don't you? Yes, it's true.
No.
I almost saw it there.
He takes it out for the podcast.
It's true. That's true.
Yeah.
No, I mean, there is.
And that's the thing is that you take a tiny company like this, they look at the market as it is right now. They invest a bunch of money in these reactors, in infrastructure, and they make projections based on current prices. But if prices get cut in half or they decline even, by a quarter, 30%, that changes the economics for those companies quite a bit. And you're right. I mean, De Beers, which essentially, from what I understand, has a monopoly almost on natural diamonds. Of course, they want to protect their market. So it incentivizes them to just flood the market potentially with man-made diamonds, and then try and differentiate the natural diamonds from that, right? Like turn artificially created diamonds into
exactly
more of a common item that doesn't have.
And right now, just to put it into perspective, too, De Beers is one of the, I think they're the second largest player. El Rosa, which is the Russian state diamond company, they have primary market share. So it's kind of an oligopoly.
In just the diamond industry overall.
In the diamond industry in general.
Right,
This is, I guess, natural diamonds.
Yeah.
Yes.
And the patented process here with Adamas one, apparently it was to produce the highest quality diamonds. Now, if there are obviously other competitors that are able to do this, and if you're talking about the machines to produce this only, costing $325,000 or under, we heard in the meeting, or under that amount. If there's another way to do this and present and create those diamonds, which as we understand there are, I'm not sure the end consumer is going to differentiate between the two. And number 2 or 3 down the road is the more that are made, if the capital outlay is only this amount, it's becomes supply and demand. If there's a ton of supply, the price of these are going to go down. And to me, I'm not certain that you can continue to have, and you've seen that Brennan put up the chart, the price is going down over time. It does seem like the barriers to entry are low, price comes down. I'm not sure if these will be worth much. The other side of the coin too is these, they used to be marketed that they were eco-friendly. Well, the energy that goes into producing those is quite high, and they're not allowed to say now that they're eco-friendly. So they are now saying conflict-free, some of them, right, that are being produced. Yep. But again, it does look a little bit like, I mean, you look at the cannabis industry. To grow cannabis, it didn't take an absolute rocket scientist, and it actually didn't take a ton of capital. It kept some, but you end up getting so much supply brought online that it crushed the market, really. So, I mean, it's not the exact parallel that's going on here, but, just the forecast from that company seemed very impressive. Whether they achieve them, we will see over time. And there's a number of factors that they'll have to fight against, and we'll monitor that. So let's move on to our next segment. Aaron's going to review some significantly larger companies. He's going to look at Facebook, which is Meta now, Alphabet, Amazon, and Microsoft.
So pretty busy
quarterly numbers
last week in the market. So Q1 earnings season, particularly in the US, is in full steam right now. Either of you want to guess as to how many companies released financial results last week in North America?
487.
200.
392.
About 750 companies.
Oh, we were adding ours up.
Yeah.
Was our guess.
Yeah.
Right. So, huge week.
So that if we're playing closest and without going over,
you
I
won.
won.
Yes, you won.
Thank you.
Very good. Very good. So huge week in the market, obviously, and the Canadian market tends to lag a little bit. So we'll start to see more of those names come out with. I believe this week is a pretty busy week, starting to get busier for Canadian stocks releasing their financial results. But a lot of companies, I was very busy on the weekend going through earnings releases. I couldn't get through all of them, unfortunately, but there were 4 companies in particular that I want to talk about right now, just given their size and importance, that released results last week. And these were Microsoft, Amazon, Alphabet, and Meta. So there's a term which is not really so relevant anymore, but it's called FAANG, the FAANG stocks. And this refers to the big 5 companies in the US market. So FAANG actually stands for Facebook, Amazon, Apple. I believe actually
Netflix was the initial one.
Netflix.
Yes, yeah. I believe that the N originally stood for Netflix, but we're calling this FAANG. The big 5 that is normally referred to here are Facebook, Amazon, Apple, Microsoft, and Google. But of course, Facebook is now Meta. Google is not Google. Google is Alphabet. So the term doesn't really apply anymore. But the whole point here is that these are absolutely massive companies, the 5 most important companies on the stock market. So if you add all of these up together, you're getting a market capitalization of upwards almost $8 trillion between these 5 companies. Now, let's just put this into context here. If you were to look at the NASDAQ, so these are all NASDAQ listed companies. There's about 3,300 companies that are listed on the NASDAQ. And there's an estimated market value of the entire NASDAQ exchange of about $19 trillion. So 42% of the value of the NASDAQ is just attributed to these 5 companies. And then the other 58% to the other 3,295 companies. So if you were to look at the S&P 500, which is the 500 largest companies in the US, the percentage that is attributable to these 5 companies is lower, but it's still about 23%. So these are incredibly important companies in the market. They absolutely move the market. They are behemoths in the global realm of the stock market. So why don't we just walk through these? We're going to talk about Microsoft first. So they released this week their Q3 results, fiscal Q3 2023. Revenue was up 7% year over year. And what was driving the strong revenue growth was a continued leadership in Microsoft Cloud continuing to grow about 22% in the quarter, 25% on a constant currency basis. Microsoft overall had operating income increase about 10% to $22 billion. Net income was up 9%, and earnings per share were up to $2.45. So these results, they exceeded analyst expectations. They exceeded my expectations. Productivity business processes revenue was up 11%. Intelligent cloud revenue up 16%. And it was just the more personal computing division, which saw a decline. So this is more of the hardware devices, and that was down 9% for the quarter. So as I said, this was a beat. The non-GAAP EPS of $2.45 beat analyst estimates by 22 cents. Revenue beat analyst estimates by about $1.85 billion. So great performance from the company, exceeding our expectations, exceeding analyst consensus. The stock has since increased 12% since the release of the results. Now, one of the big things we've been hearing a lot about Microsoft that we've spoken about as well is a huge buzz around their investments into OpenAI, which is the developer and owner of ChatGPT. So this is currently the most advanced artificial intelligence technology in the world. Microsoft has a partnership with OpenAI, and they are in the process of integrating AI across their entire software services suite. So one of the things that they have done recently is they've upgraded Bing with a new chat service, which is powered by essentially ChatGPT. So you can actually have a conversation with the search engine, which is somewhat unique. Analysts for fiscal 2024, they're looking for growth of about 14%. So their fiscal year, Microsoft's fiscal year, that actually starts in July, a little bit different than the other tech companies that we're going to talk about. But $10.93 in earnings per share, that would put Microsoft at a valuation of about 28 times earnings based on forward expectations. So great performance for Microsoft. Very interesting space that they're in right now with the AI. They've really propelled themselves to the forefront of the AI race. And then as well, performing extremely well in cloud. Their Azure cloud computing platform continued to increase market share in 2022, owning about 23% of the global share of the cloud computing market, which was up from 22% in the year before. Next, we will talk about is Alphabet, which is the parent company of Google. So they released their Q1 2023 results. Revenue was up 3% year over year. Google Search produced $40 billion in revenue. Google Cloud, $7.5 billion. About one thing that's important to note, Google Cloud, Alphabet's cloud computing platform, it is growing. It is acquiring market share from competitors. However, it is actually not profitable right now. So nearly all of the company's profit comes from Google Search. Operating income for Alphabet decreased to about $17 billion, down from $20 billion. Operating margin was 25% for the quarter compared to 30% in the same quarter last year. And then net income fell from $15 billion or $1.17 from $16.4 billion last year or $1.23 per share. So one of the things that impacted Alphabet in the quarters, they recorded about $2.6 billion in charges related to workforce reductions or essentially laying off people. It's a big theme in tech right now. Companies are laying off people. They're really trying to streamline their operations and focusing on margins, which is something they have not had to do in recent years. But still a great beat by Alphabet. Their earnings per share of $1.17 beat analyst estimates by 10 cents. Revenue of just under $70 billion beat by about $1 billion. Now, Alphabet has recently released Bard AI. This is in response to competition from ChatGPT and also Microsoft's new Bing. So Microsoft has been very vocal that they're going after Google for share of the search market. Bing has been, not really taken that seriously in the past, but now that they have upgraded it with ChatGPT capabilities, they may have injected some power into it, and it's starting to get more interest. So Alphabet is seen by many as now on the defense, and it's up to them to create a response. That response has been Bard AI, but Bard AI has not yet been released publicly. So I'm personally on the wait list. I have not been able to play with it yet. I have seen some demonstrations where people have compared it to GPT-4. In some areas, it's comparable, in others, it's not. But in any event, Alphabet has a reputation of having some of the best AI engineers in the world. One of the top AI companies in the world, bar none. So it'd be interesting to see what they come out with. Now, looking forward, Analysts for the current year are expecting earnings per share growth of about 15% to 524. And that puts the valuation of Alphabet right now at about 20 times earnings. So one of the things about investing in Alphabet is they do have the overhang of the potential of increased competition from ChatGPT and the new Bing. But that is also factored into the stock price. So 20 times earnings, this is one of the lowest valuations that Alphabet has traded at in its history as a public company. And analysts are still expecting growth this year. So we will keep a close eye on the company over the next couple of quarters and see how things trend. Next up, Amazon. So they put out their Q1 results. Net sales increased 9%. North American net sales up 11%. And AWS, which is their cloud computing service, increased sales 16% year over year. Operating income in the quarter rose to $4.8 billion, up from $3.7 billion. AWS, the cloud computing operating income, reached $5.1 billion. So this is something that we really have to pay attention to here. Overall operating income for the entire company, $4.8 billion. Cloud computing operating income, $5.1 billion. So what is that telling you? It means that the only profitable part of Amazon's business is cloud, right? So when we think of Amazon, we typically think of Amazon.com, the e-commerce platform, but it actually doesn't make that much money. And in fact, currently it is losing money with Amazon.com. And really it's the cloud computing that has been bolstering the business. And this has been the case for some time. Certainly cloud is leading the company in terms of profitability and growth. But one thing that we also have to note with the cloud computing platform is that, well, the two biggest competitors, Microsoft Azure and Google Cloud, have been growing their market share in the high growth cloud space. Amazon is not. Their market share, although they are number one, it's been pretty stagnant, the 33% of market share globally. It's been stagnant there for the last several years. And then they've also noted that cloud growth is starting to grow or slow just the overall market. So this is something to keep an eye on. But they did outperform analysts' expectations by quite a margin. Earnings per share of 31 cents, beat estimates by 11 cents. Revenue of $127 billion, beat by almost $3 billion. They did put out guidance for the second quarter. They expect net sales to grow between 5 to 10% year over year. Cloud computing, of course, once again, this is the primary driver of growth and profitability. So, it is somewhat concerning that they're not able to grow their market share in that space while their two next largest competitors have been. Looking at analyst estimates for the current year, the midpoint of consensus is for Amazon to generate earnings per share of $1.54. This is up from a loss last year. And this puts the valuation of the stock at about 66 times earnings. So Amazon has always really been the most expensive of the big five. Whereas if you look at Microsoft, Alphabet, Meta, Apple as well, the valuations have been fairly reasonable. Whereas Amazon has always traded at a big premium to the market. It also has a more levered balance sheet than the other companies. So generally speaking, Amazon has been our least favorite of the group. And then there's Meta Platforms, finally. Meta, formerly Facebook, released their Q1's 3% year-over-year revenue growth to just under $29 billion, driven by a 26% increase in ad impressions. However, the average price per ad has declined by 17%. Net income was down. Earnings per share were down for the quarter. They did report a 5% increase in daily active people, daily active users. And Facebook monthly users also increased by 2%. Now, Meta's talked a lot, has been very active with respect to laying people off, as many tech companies have. In March of this year, they announced 3 rounds of planned layoffs. They want to reduce the employee count by about 10,000. That's fairly significant considering at the end of the quarter Q1, the head count of the company, the total number of employees, was 77,000. And that number does not include the 10,000 that they announced that they will be laying off. But a fairly significant beat on the net earnings line. They reported $2.20 in earnings for the quarter, beating estimates by 23 cents. Revenue of $28.65 billion, beating estimates by 990 million. The stock price performed extremely well since the release of the results, up 14%. And they have also provided guidance for the next quarter, revenue between 29.5 and 32 billion. So that would be year-over-year growth of between 2% and 11%. So analysts this year have them growing at midpoint of the analyst consensus as EPS increasing 25% in 2023 to 1075. And this would put Meta at a valuation of about 23 times earnings. Looks like analyst expectations for growth next year as well are fairly optimistic. We'll see how the company does over the next few quarters.
Well, that was a good summary of the big tech. Yeah, I mean, we've looked at those names multiple times, many times over the past 5+ years, and we have some favorites in there, our current buys on the list, and they continue to perform well. And I think they need to continue to be a part of a well-diversified or a well put together, not necessarily well-diversified, well put together portfolio.
I wonder what Kramer's thinking right now is, because I've been seeing so many headlines talking about, Meta's been running, it's the best performer right now. But I wonder what Kramer's thinking.
But didn't he cry and say he was wrong?
That's what I mean. I'm wondering
if wasn't that the exact moment it turned around? Or just kidding.
Probably.
Yeah, basically. Oh, impressive.
I'm sorry. I'll just say we're picking stocks here. There's no need to cry on the news.
No. He'll cry if he wants.
It's crocodile tears.
Cry if he wants.
We want Brennan to sing. That would be great.
Yeah,
that's what we should do. All right, let's get on to Brennan. Or actually, we're going to talk how Brett's going to look at one of the biggest stories. The biggest stories of the week: collapse. First Republic Bank. I'll let you take it over.
In March, we saw the voluntary wind down of the crypto bank Silvergate Capital, the swift collapse of Silicon Valley Bank, and the Swiss bank Credit Suisse having a shocking marriage to UBS just before falling apart. But now, after teetering on the edge of failure over the past month, JP Morgan and Chase has taken over the majority of First Republic Bank's operations after a Sunday night deal, making it the largest U.S. bank failure since 2008. Let's go through a nice timeline of the events that have led up to the failure of First Republic. Before the collapse, as interest rates have risen over the past year or so, the company saw its net interest spread, which is the difference between the rate it receives on its loans and the assets compared to its cost of borrowing, shrinking from 2.58% in Q4 2021 to 1.74% in Q4 2022. So this was before you saw any major change in the stock price. No collapse at this point, but it's already looking a bit riskier as its earnings, or its net interest margin, which leads down to its earnings, has shrunk. So during the series of failures and takeovers in March, First Republic saw its about $100 billion in deposit outflows, which is due to its roughly 80% being of its 177 total deposits being uninsured. So all those uninsured deposits, they were getting scared. They were running to the big banks. They were pulling out all their money. In addition to that, so the FDIC backed the deposits they've received, then $30 billion in support from a coalition of banks, including JP Morgan, to help the shortfall from the deposits all withdrawing, but they still roughly had a shortfall of $70 billion. In the same announcement of them receiving funding from these banks, they also suspended their dividend. Great sign so far. So, and this was all in March, and now we're moving a bit forward. So a month later, we see the Q1 earnings, which show the extent of the bank run, all the details, all the hiding operating costs, and all the restructuring parts of it. As the short-term loans it has taken on were based on higher interest rates, its running cost to borrow was pushed up to 2.73%, up from 1.76% in the last quarter. So a 3-month difference, and they're up a whole percentage point practically in their net borrowing costs, which is massive for a bank. In the last quarter of last year, it was only 0.19%, just to give you an idea how it was already increased. On the other hand, loans were only 3.66%, up from 3.51% in the last quarter, compared to 2.78%. So yeah, they were getting more on their loans, but not nearly as much of an increase. It was about a 2% increase on the borrowing, 2.5%, versus 1% on the loans, what they were receiving. So a big difference in the spread getting crushed. Their net interest spread is now 0.93%. However, this also includes their non-interest-bearing loans, so those are your checking deposits and accounts like that, where they're not paying money on it. When you only consider the funds which the company is paying interest on, its cost to borrow is actually 4.33%. So that is more than what they were receiving from their loans at 3.66%. So just holding on to these loans, we're losing them money, meaning that they now need to offload these loans, and they would realize significant losses on their books, as many of these securities have decreased in market value over the past year compared to the accounting book value, as they're considered being held to maturity at the time, so they don't actually realize the market value loss as they occur. They only realize the amortization, which skews it. And this is something which we also saw in Silicon Valley Bank. So as the bank effectively had no other choice because they were losing money on it, they have to offload these loans. They announced this. But the market didn't like this, of course, and they shouldn't like it. So the day following the earnings, the shares fell, rightfully so. It cut from at 16 the previous day to about $8. And by the end of last week, the shares were only trading at $3.51. And just a reminder, before the fall at the March, when all the banks were collapsing, the company was trading at about $120 a share, a 97% for a bank in over a month. Last weekend, regulators seized the bank and had an auction for the bank's assets, with JP Morgan taking over the majority of these assets. JP Morgan will pay the FDIC about $10.6 billion, but this fiasco also cost the Deposit Insurance Fund, which the FDIC runs, an estimated $13 billion more. We'll have these final figures probably work out in the next couple of weeks. So as far as the First Republic shareholders go, they receive nothing again. So your equity holders wiped out. This is not the first time JP Morgan has taken advantage of distressed financial companies. They were a big player in the 2008 crisis. They took over Bear Stearns, and as well as Washington Mutual, the previous largest U.S. bank failure. Well, it still is. It's the largest, and then this is the largest since that. Regulators waived the 10% total deposit limit, which JP Morgan was already past, so now they're even a bigger bank. And there's your too big to fail coming up in 5 years or so. I just about that. No idea if that's going to happen. But in summary of the event, the bank has been having seen a shrinking net interest spread already. Then the bank saw a significant outflow due to these uninsured deposits, which further crushes net interest spread to the point of losing money on its holding loans. In other words, they failed at the core operation of a bank, lending more from what they can borrow for. If we look at the causation events, it's similar to SVB. Management failed and it exacerbated a bank run. The company could have immunized its interest rate spread by running into swaps. It's a very common thing. There's hundreds and hundreds of trillions of outstanding swaps, just to give you an idea. It's not like it's an obscure market. They could have done this. Banks do it all the time. And they wouldn't have seen this issue where their spread gets smaller and smaller. It would have stayed the same, but it would have been slightly lower than it would have its peak. And that's what they were doing. They were taking on more risk. And then once the interest rate structure starts to change, they're starting to accumulate that risk. And then it hits this point and it crushes the bank immediately. So as I've said before, though, any bank can really be susceptible to a bank run. Even the biggest banks, if there's a big enough bank run, they'll get taken out. But the riskier bank and the weaker the operations like we saw here, the more likelihood it is. So you can say, oh, it's the bank run's fault. It's the companies for pulling out. No, it's really the management's fault. You can add like 1% onto people taking out their money, but pretty much anyone would do if you were in their case. If you saw your money actually at risk, if you weren't insured, you'd probably be doing the same thing. And then it's the bank's job to understand these risks, and they did not understand the risk clearly.
Awesome.
Yeah,
I mean, psychology is really everything when it comes to the banking industry. I mean, there needs to be trust. The whole point of a deposit is that you can access it when you need to, but if everybody accesses it at the same time, I mean, the bank doesn't have all your money there. The business model of the bank is to take deposits and then loan those out. So if enough people want their money back in a short enough period of time, the bank has to deny them.
Yeah, that's why you have to run it well, right? You just have to run it well. And these just weren't being run well.
Yeah, exactly.
I mean,
and then of course, another issue right now is that banks with some of their capital that they use to return deposits, they'll put into treasuries. Well, if you bought treasuries, a couple of years ago, then with interest rates going up, the prices of those treasuries decline. Then if you have to go to the market and sell them so that you can pay back depositors, you're selling them at a discount. So it's a bad thing when it happens.
Yeah. And I mean, like Warren Buffett alluded, I mean, this was the beginning of April. He ended up going on CNBC Squawk Box, alluded to, he basically said, you know, we're not over bank failures, but depositors haven't had a crisis. And he says basically banks go bust, but depositors aren't going to get hurt. And then he goes on to say the costs of the FDIC are borne by the banks. Banks have never cost the federal government a dime. The public doesn't understand that. He added, nobody is going to lose money on a deposit in a U.S. bank. It's not going to happen. You don't need to turn a dumb decision by managers into a panicking the whole citizenry of the United States about something they don't need to be panicked about. So again, it just comes down to, you know, managers making a dumb decision and then, you know, everybody panicking, run on deposits.
All right, let's move on to our final segment. Brennan, you're going to take a look into banks more, and they're extending their mortgages en masse to try to ease some of the pain, just extending those over longer terms. And you're going to get into why that is occurring and should it be occurring.
So yes, it recently came to my attention that Canadian banks have begun extending mortgage amortization periods on outstanding mortgages as an attempt to help ease the pain of some Canadians facing higher interest rates and ongoing inflationary pressures. And there have been multiple articles out there, such as this headline, which I have up on the screen, that indicates a third of Canadian homeowners with a mortgage now have amortization periods of more than 30 years, with major lenders like RBC, BMO, CIBC, and TD seeing sharply higher percentages of their mortgage portfolios with amortization periods north of 30 years. And to put this into perspective, none of these banks had mortgages with amortization periods over 30 years in October of 2021. And as of the fourth quarter, roughly 30% of their mortgage portfolios had amortization rates above 30 years. So let's pull up a few of these banks' mortgages by remaining amortization tables to see how they really look. So first here, we have CIBC. So you can see in October of 31st of 2021, essentially they had no loans or no mortgages with an amortization greater than 35 years. Now, I guess this isn't the most recent quarter, but the previous quarter before that, 26% of their mortgages were now over 35 years. With RBC, same thing we can see here. In 2021, no mortgages over 35 years, now about 23% of the portfolio. And if we move on to TD, we can see this exact same thing. In 2021, nothing essentially. And in 2022, about 25% in Canada. So what does this mean for Canadians and banks? Well, number one, Canadians who now have an amortization period of over 35 years are going to be paying much more in interest. So using my handy dandy financial calculator, I quickly whipped up this table, which compares a $500,000 mortgage paying an interest rate of about 4.5% over 25 years and a 40-year amortization period, just to compare them. And as you can see from the table that I have up on the screen, the mortgage with the longer 40-year amortization has a lower monthly payment of approximately $2,250, but 83% of that payment is going to interest, while only 17% is going towards paying down the principal. So although Canadians who have extended are avoiding some near-term pain, they are essentially moving closer to renting their homes from the bank, as their monthly payment just fractionally goes towards the principal on their mortgage. And for the banks, while the strategy may be attractive, it is not without risk, as it keeps borrowers in debt longer, and as I indicated, leads to much more interest being paid over the life of the mortgage. Now, the question was recently raised to the Bank of Canada Senior Deputy Governor Carolyn Rogers on whether she was concerned with the situation. And she noted that the Bank of Canada asked this very question to several unnamed banks in April, and that lenders are concerned about ever-growing amortization periods. Now, there are a few caveats here, as from my understanding, in most cases, the extended mortgage contracts will revert to the original amortization schedule at the next term renewal, which of course will translate these Canadians into higher mortgage payments. So eventually this pain will come in. They're just essentially delaying it. And I also wanted to show here in the Bank of Canada's monetary policy report for the month of April, they also indicated that mortgage borrowers have been ditching the 5-year fixed rates and variable rate mortgages for shorter term fixed rates, and that both the 1 to 2 year fixed and 3 to 4 year fixed rates are on the upswing, comprising roughly 30% and 25% of all new mortgages in 2022, respectively. Now, moving forward, this is definitely something that we will continue to monitor. And yeah, I guess now I'll just open up to the guys to see if they have any comments.
Oh, that's great breakdown, Brendan. I love how you pulled the data right from the bank financial statements, financial reporting. My first thought when I read the headline there was that seems high. That's shocking to me that that changed so quickly. But I mean, you had the numbers.
But you see it there right in print. It is fairly shocking, and it is interesting. I think the tidbit you had in there, the terms are reverting back to the original terms.
Yeah.
When the mortgage is due. So if someone had a 5-year term and they amortized for 25 years. And its initial 5-year term they had under contract, it should, and if they extended it to 40 years, for example, and they were 3 years left and 3 years, that should then, in theory, go back, or they could go to a 25. Exactly. I mean, right then they're hoping that rates go lower, because if they don't, I mean, unless their income has increased over those 3 years or 2 years up to the term, they're going to be in the same situation. So they're going to need the 40 years once again. If interest rates higher, they might need even more. But if they come down, perhaps they're betting that would happen. But it is certainly pushing the pain into the future at some point. Yep. If everything stays the same, rates stay the same, unless their income goes up or they find some other way of generating income, they won't be able to afford a 25-year mortgage at the rate it's at right now. So, something will hit the fan at some point, unless for these people, rates go lower. And it is a significant now portion of those mortgages. And will it continue to increase? Like, that's something to track if you get to 40, 50% of the mortgages.
Well, I mean, it's gone up from nothing to
astronomical,
significant number. So, I mean, this is how Canadians have been dealing with the higher rates.
Mm-hmm. Yeah, I mean, we've kind of been saying, how is this happening? How is it happening? Well, they've just been allowed to extend.
One would have expected more of an impact maybe to the housing market given where rates were, but this is a clue as to what's been going on. Well, in Japan, they have 100-year amortization mortgages.
Wow.
Yeah.
So
it is just crazy too to see like how many people were taking out variable rate mortgages, in 2021. And, I mean, which was,
is that 50%?
Yes. Yeah.
Variable.
50% variable, at that point.
Yeah.
And I mean, yeah, I didn't even expect that, but
you would think logically too, it should be reversed where you're taking out the fixed rate when it was low and then the variable rate when it's high.
But is that interest rates at the time?
Is that the bank like pushing?
You could have got around that time. You could have got a 5-year fix for less than 2%.
Human beings want their cake and to eat it too. They'll get the lowest payment possible there at that moment and be able to afford the shoes they want the next day as well, right? So I mean, that's literally what's going on there, in my opinion. And they're just not planning for the future. What if rates go up? Well, they won't tomorrow. So then, I get to buy the shoes and go on a vacation.
There's just the narrative, like they've been low for so long. There's just the narrative.
Yeah.
That people are like, oh, no, they're not going to go up. Right?
The thing, there wasn't there wasn't a monumental difference between the two. You know what I mean? Like your variable and a well-negotiated fixed rate at that point, right? I think the fixed posted rates drove people towards the variable, but almost no one had to pay a fixed posted rate at that time. And you can negotiate it down significantly just with a slight bit of checking around. But people don't want to do that often. And, it's something that I would advise always do. Don't pay that posted rate. Go out there and shop it around.
Yeah.
Especially, if you want to lower your rate, which you should, it should be huge. And it's a big part of your life, your mortgage, your house. So anyways, hopefully you pay attention to that. If rates do come down again, it's a good time to lock in.
Yep.
It's pretty simple. All right. Well, that's going to close out our show for this week. It's great to be back with you guys, although I don't think we didn't even miss last week. We just left the day after, but it's great to be back. It was an interesting trip to Vegas. Some new companies we may introduce to our clients. I'd like to always wish everybody, first off, I'd like to say smash the subscribe button. Smash that button. If you like the content, you're watching this on YouTube, rate us. If you're listening to the podcast, rate us on iTunes. Continue to do that, and we'll put out the content every week. And I say thank you and profitable investing.
Thanks.
Thanks, everyone.
Thank you.